In the outskirts of Omaha, a party is raging on. At this party is a lawyer. On the outside, he is smiling, but on the inside, he's breaking apart. He's just gone through a divorce, lost his son to cancer, and now his dad. He didn't want to go to the party initially, and there would have never been this epic meeting that's about to take place, and we would never be able to tell this story. Together, they will build the world's biggest investment empire from scratch. Some have called them the fathers of value investing. Others believe they're just wolves in sheep's clothing.
That's because up until now, Warren Buffett has been squeaky clean.
Absolutely, that's a central part of the Buffett brand. It's a reason why companies are so eager to be taken over by him.
But they all agree on one thing. They are the titans of investing. 10 years later, the two will do a hostile takeover, giving birth to a corporate giant that is worth more than an entire state. Governments will try to stop them and fail.
Warren, if people weren't so often wrong, we wouldn't be so rich.
Competitors will file antitrust suits against them and fail.
Take a look at Berkshire Hathaway. Class A shares topping $500,000 yesterday for the first time. Shares up 10% on the year.
Politicians will sponsor riots against them and fail.
I'm optimistic about life. I can be optimistic when I'm nearly dead. Surely the rest of you can handle a little inflation.
But for now, there's just that, a firm handshake. Charlie Munger, barely 4 years old, is thrust into a crumbling world.
People like you have just no idea what the hell it was like. There was just nobody had any money. The rich people didn't have any money.
Luckily, his father, a lawyer, is a financially savvy dad. He's done a few investments. He has done better than the average Wall Street bets degenerate. Hence, the investments are keeping the family afloat. Similar to how you can keep this channel afloat if you subscribe and leave a comment below. Man, who writes these scripts? That was a smooth segue. While most families struggle to get their daily meal, even sending kids as young as 7 years to work in farms, Charlie gets a soft landing. His mother keeps him at home and begins homeschooling him. She soon realizes he has a special ability.
When I was young, I could get an A in any mathematics course without doing any work at all.
Because of this, Charlie Munger becomes what most people would refer to as a nerd. So much so that teachers begin resenting him, and this only pushes him deeper into his books. Little does he know that his love for crunching numbers will be his main catapult into the world of billionaires. And through his pursuit of math and physics, he will learn a very important skill in investment. Invert. Always invert. At 12 years old, he applies for a job at a nearby grocery store owned by Ernest Buffett, Warren Buffett's grandfather. Unfortunately, Warren Buffett's grandpa doesn't give two shits about Munger. He's just another employee. Yo, since when do we write such vulgar scripts? Anyways, all he cares about is his bottom line. He treats his employees as he would his donkeys, making Charlie work at his store every Saturday for 10 hours a day. He gets kind of a modern day equivalent of working as an investment banking chimp, only he's paid $2 per day. Although the job is one of the most boring gigs he's ever done, he gains a very useful skill that he will put into good use when he joins the military later. But before then, he's about to commit 2 grave mistakes and learn severely from them. Charlie joins Central High School, graduates top of his class, and starts his inversion strategy. He enrolls to the University of Michigan to study a bachelor's degree in math. While pursuing this course, his attention is drawn to something interesting. It's not a female, since there's very few females in a math bachelor. Instead, he notices that problems in physics are solved in reverse. You start with the end result and trace it back to the cause. He calls this strategy invert, always invert. Japan has attacked Pearl Harbor and the US has been caught pants down.
The United States of America was suddenly and deliberately attacked by naval and air forces of the Empire of Japan. No matter how long it may take us to overcome this premeditated invasion, the American people in their righteous might will win through to absolute victory.
Every kid in college is getting drafted. Once drafted, every recruit takes an IQ test to determine the tasks they'll be assigned. Charlie Munger's test results come back exceptional. In layman terms, he is a genius. And typically geniuses are not thrusted into the battlefield. He's promoted to second lieutenant and shipped off to Alaska. After completing a short course on meteorology in California Institute of Technology, he starts his work in the military meteorology department at an Alaskan military base. His task is simple: predict weather patterns so that the Air Force pilots know where to maneuver. And he reverts to a simple inverting strategy.
I said, how can I kill these pilots? Now, that's not the question that most people would ask. But I want to know what the easiest way to kill them would be so I could avoid it. And so I thought it through in reverse that way. And I finally figured out, I said, there are only two ways I'm ever going to, I was in the ferry command, there are only two ways I'm going to kill a pilot. So I'm going to get him at icing his plane can't handle, and that will kill him. Or I'm going to get him someplace where he's going to run out of gas before he can land because all the airports are sucked in. And I just was fanatic about avoiding those two hazards.
The downside? He's confined to a single room with a single bulb light and hundreds of weather maps on his desk every day. His brain power is underutilized, so to jog his mind during breaks, he plays poker with fellow soldiers. See, playing poker is a lot like venture capital. That's why a lot of the VCs that I know personally, they love it. It means the odds are almost always stacked against you. So you better have a probabilistic mindset and be ready to pounce on opportunities. And when they come, you must bet big. He gets married within a short period of knowing his significant other by applying what we call expectation management.
Charlie's big on lowering expectations.
Absolutely. That's the way I got married.
Out of this glamorized marriage comes 3 beautiful children, 2 girls and a boy. But tragedy comes knocking. Not once, twice. And it's only a matter of time before he feels the pain of being the man in the family. Once World War II ends, Charlie goes back home, but he has no degree to go back to, so he starts studying.
So when you went to Harvard Law, why law?
Well, my grandfather and father had been lawyers, and I knew I didn't want to do everything else.
At Harvard, he puts aside his love for crunching numbers and begins reading law books ruthlessly from cover to cover. In 1948, he graduates magna cum laude with a Doctor of Law. On this channel, we all know how desirable a career in high finance is today, mostly for the extremely high salaries and amazing exit opportunities into private equity, venture capital, and other industries. But we also know that hundreds of thousands of candidates get rejected during the application phase each year. So before we further explore Charlie's incredible career and life, let me introduce you to today's sponsor, Wall Street Oasis, that aims to solve this problem. With more than 17 years of experience helping students break into their dream high finance jobs, they know how to get you one of these lucrative roles. The success of their students speaks for itself, as they have landed positions at all of the top firms. With the Academy, you will get access to vast resources, including exclusive networking resources, courses, and unlimited support. And it is not only for target school or 3.7 plus GPA students. They have helped applicants from all backgrounds to greatly increase their chances to land that high finance job. In fact, they are so confident in the success success of the program that they will give you a guarantee to receive a job offer in high finance, or you get your money back. The onboarding process is very selective, so click the link in the description now to apply to the waitlist and you will be near the front of the line. Click the link in the description below for this exclusive benefit. And now back to Charlie, who at first chooses another path besides finance. Immediately after graduating, he takes up the California bar exam and begins practicing law. First order of business, join a law firm. Second order of business, quit the law firm.
And I found that people could tell me when I thought they were idiots. And that is not a way to rise in a big organization.
He also notices how everyone in the law profession is keeping up with the Jonases, yet he's never had to do that before, and he's not going to start now.
It worked out okay. So I had to leave the profession. It was a dumb profession for me to choose.
So he starts his own law firm before making one of the worst decisions of his life. A decision that will anchor all of his future investment decisions. A decision that may arguably be the only reason why he and Warren become as successful as they are. The beauty of being a lawyer is he meets different successful people from different fields. Ed Hoskins is one of those people. Ed has a company that makes highly specialized transformers for military equipment. Thanks to the ongoing Korean War, there is a huge demand for these. In the true spirit of a megalomaniac, Munger hatches a plan. Ed is 90 years old, so naturally there are tussles in his firm over succession. The company's stock is not doing well. Munger swiftly takes that opportunity. He buys the company and assumes full control. And no sooner has he bought the company than the Korean War ends. Demand drops, and he finds himself with a shell of a company that no one needs. And while his first investment is collapsing in front of him, back at home, his wife is filing a divorce. She ends up getting full custody of the 3 kids and most of his properties. He is left with nothing. And just when you think he's seen the worst, his last-born son gets diagnosed with leukemia, the dreadful blood cancer. And as his son's life creeps away, so do his life savings for medical bills. A dejected Munger crawls away into the abyss of despair, with no family to go back to and no money to wish his sorrow away. But when you've reached rock bottom, there's only one way to go. And if you thought he was done, he has just begun.
One is never feel sorry for yourself. If your child is dying of cancer, don't feel sorry for yourself. Never, ever feel sorry for yourself.
By 1959, Charlie Munger has already remarried, and funny enough, his second wife is also known as Nancy, just like his first wife. Together they have 4 more children, on top of 2 stepkids that Nancy comes with. In that sense, you could say he's similar to Elon Musk, who's single-handedly trying to solve the population decline.
I had an army of children almost immediately.
In 1959, his father dies and he's forced to go back to Omaha to do funeral arrangements for his dad. And in Douglas, he catches up to an old-time friend who wants him to go to his party. Charlie, oblivious of the impact this party will have on the rest of his life. Warren is just a young lad, younger than Munger by 6 years, but his career has just started picking up, and word around is that he's a successful investor. The two get to know each other until Warren finally says, "If you're doing law as a hobby, that's fine. However, you can do much, much better." After this enlightening encounter with Warren, he goes back home a renewed man. First order of business, buy a home. Second order of business, split it in 2 and sell the other half. He makes a killing, so much so that he starts seeing himself as a real estate investment guru. When he handles the legal papers of a client who wants to sell a property, he throws in his unsolicited advice. The property is in LA, a fast-growing city back then, very different from today. He tells his client if they can build an apartment, hold it, and then sell it later, they will make a huge profit. His client thinks it's a nice idea, but will only do so if Munger invests in the venture too. Munger says, why not? 5 years later, their $100,000 investment turns to $500,000. As many young people, including me, learn way too late in life, if something works, double down. He repeats the same strategy 4 times, and by 1967, he has already achieved millionaire status.
I created 5 real estate projects. I did both side by side for a few years, and in a very few years I had $3 or $4 million.
But remember, Charlie is a jack of all trades. And so while he's doing these real estate projects on one side, running a law firm on the other side, he has partnered with another former workmate to start an investment firm, Wheeler, Munger & Co. In fact, Munger's investment firm outperforms S&P 500 for the 10 years it's in operation, with a 19% annual average return compared to the 5% of the S&P 500. And while it does poorly in the last 2 years before its closure, thanks in part to Charlie Munger's insatiable risk appetite, he makes up for it with a 71% return in their final year. In the meanwhile, Warren Buffett does not have a rosy time. While Munger is busy beating the S&P 500 market returns, Warren Buffett is on the other side struggling with dying companies. You see, Warren is using an investment strategy he picked up from his former lecturer at Columbia Business School.
Well, Warren had been taught by Ben Graham to buy things for less than they were worth, no matter how lousy the business was. You can't imagine a more lousy business than New England textile mills.
The strategy that Warren Buffett employs is very simple. Find companies that are trading at lower value than their book value. He calls this the cigar butt strategy. The many dozens of free puffs he obtains in the 1950s make that decade by far the best one for him. But with investing, the game doesn't always go your way, and as a man with a high temper, he is about to make a massive mistake. In 2010, he claims that it was the biggest investment mistake he has ever made, and that it has denied him compounded investment returns of about $200 billion over the subsequent 45 years.
The original purchase of Berkshire was a terrible mistake, and my mistake. No one pushed me into it.
In 1962, Warren Buffett begins buying stock in Berkshire Hathaway after noticing it is statistically undervalued, and he will be able to sell it back later through a tender offer.
And Berkshire was selling below working capital, had a history of repurchasing shares periodically on tender offers.
Warren starts purchasing Berkshire shares at $7.5 per share, with the expectation to sell it at around $11 or $12 some years later. And unsurprisingly, in 1964, the CEO of the company asks Buffett at what price he'd be willing to sell his shares back. Buffett says $11.50 and waits for the CEO to make his tender offer. When he receives the written offer, he's irritated.
It was an eighth below what he had said to me and what I'd agreed to.
Buffett doesn't tender. Instead, he buys a lot of shares in the company. His new mission? Fire the CEO for his audacity to undercut him by an eighth of a dollar per share. He succeeds, gets rid of the leadership, and realizes he bought a massive problem. The industry is in decline, and there's little hope he can turn around this business.
But the business was going to die, so the only way to go forward from there was to wring enough money out of this declining textile business.
He starts closing the textile mills down with little regard to his employees' farewell, trying to squeeze profitability out of the business. And in the coming years, it dawns on him that it might be time to replace the cigar butt strategy for this Berkshire Hathaway cigar butt. Maybe Charlie can help. Up until 1967, Charlie has been running a successful investment firm. One of the companies he has his eyes on is Blue Chip, a stamps issuing company. Munger has been monitoring the company closely, and he's about to make a move on the company when Warren approaches him. He wants to sell Berkshire Hathaway to him, but Charlie can see that it's not a good business. Instead of liquidating Berkshire, He proposes to Warren to buy blue chip stamps using Berkshire Hathaway's surplus money from the sale of mills. Why? Because the stamps issued by blue chip are like an insurance premium.
The trading stamp business, as those of you who followed it all know, it only works because of the float.
Users don't need to use the stamps immediately. In fact, most users collect them over a long period of time until they are worth enough to make big purchases. So during this free hold time, that unused money stays in blue chip accounts. This idle money is called float. And it's here where the two oracles of Omaha hatch a plan. What if they could use that float to acquire other companies and grow their portfolio? And they go on to do exactly that, applying a simple but effective investment strategy, maybe the greatest of all times.
That's the main secret of Berkshire. The reason it's been successful is we try and buy things that aren't going to require much managerial talent at headquarters. Everybody else thinks they've got a lot of managerial talent at headquarters. And that's a lot of hubris.
With this strategy, they do the diametral opposite of what private equity firms do.
Private equity frequently buy a business where the founder is going to leave, then they go and hire talent to run it. That is a tough way to make a buck, and I don't like it. We generally buy with the talent in place.
Prior to meeting Charlie Munger, Warren has been using the cigar butt investment strategy. It has worked well so far, helping Warren beat the market with a 23% average annual ROI. But it has also been ridiculous sometimes.
He bought a windmill company in a little town in Nebraska, and Warren didn't know anything about running a windmill company.
Equipped with these experiences, Warren and Munger team up to buy Blue Chip, the stamp company, and get that sweet float. Conveniently, the Department of Justice has filed a suit against Blue Chip and successfully litigated them. The stock value declines, and the duo, through Berkshire Hathaway, start buying Blue Chip stock slowly but surely, so much so that Warren becomes the largest shareholder.
We've always had an interest in float businesses of one sort or another, but blue chip stamps was such a business, and we like that sort of business. But most of the float businesses, the costs are pretty explicit.
He then sets himself as the chairman of Blue Chip Stamps, giving him full authority on running the company and using its cash flows. Mission 1 accomplished. Mission 2, rinse and repeat. Buffett and Munger begin scouting for their next prey. So as they crunch numbers and look for their next purchase, they are drawn to one company. The company is called See's Candies. It's the most popular store on the West Coast. It's raking in revenues of about $4 million pre-tax while utilizing only $8 million of net tangible assets. Moreover, the company has a big asset that does not appear on the balance sheet. Exactly what you want to see, whether you're building a conglomerate, a fund, a micro PE, whatever. A broad and durable competitive advantage that gives it a lot of pricing power. At first, Buffett is not convinced, but Charlie has seen its value from a mile away. After back and forth, the owners agree to accept $25 million for the company. Using Blue Chip Stamps cash flow, they buy the company on behalf of Blue Chip. This becomes one of the most important investments for Berkshire Hathaway. To date, See's has earned $1.9 billion pre-tax, with its growth having required an added investment of only $40 million. While Charlie is busy having a party, another business is unwittingly trying to copy his success. Mrs. Stovers has seen the rise of See's Candy and wants to join the party, only they won't have it. Chuck Huggins, See's Candy CEO, has spotted them, and he's about to unleash his secret weapon. Why? Because Mrs. Stovers is copying everything to a T. They aren't just dipping their toes in the chocolate-covered waters. They are copying See's store designs, colors, and candies. It's a candy war. and Charlie Munger is here for it. Tasked with neutralizing Russell Stover, Charlie assembles an army of lawyers ready to attack. But just before they do so, Mrs. Stovers backs down and agrees to change their marketing strategy. Charlie becomes the leader of the defense forces of Berkshire Hathaway, and he remains so to date. And when the SEC attacks, Charlie will be there to save the day once again. While on their hunting streak, Buffett and Munger stumble upon another equally attractive company. Everything seems perfect at first. It's a savings and loans holding company. It's essentially operating like a bank, which means it holds huge amounts of float. This is like a Wall Street wolf seeing a bountiful feast laid out before it, ready to pounce on the juicy cash flash. Buffett and Munger decide to throw in their offer. A bidding war ensues with another company that has been eyeing Wesco for some time now. Buffett and Munger manage to convince Wesco to sell their shares to them instead. Wesco agrees. This news leads to Wesco stock tumbling from $16 a share to $11. This would be a massive opportunity for profit for any moralless capitalist. But Charlie and Warren want to send a signal to Wesco. They have good intentions. They buy the stock at $17 a share, foregoing a profit of $5 per share. This deal doesn't go unnoticed in the easily spooked offices of the SEC. And when the markets crash in 1973, the SEC prosecutors want to send a signal to the market and make sure they are extra diligent in policing market activities. One ruthless man with a keen eye for deception has spotted their secret underdeals, and he's ready to make an example of them. According to him, the only reason Buffett and Munger would overpay for a deal is either if they were hiding some illegal business or if they were just not smart, and the latter is highly unlikely. Their numerous mergers and acquisitions do little to help Berkshire's case. But the biggest asset of Berkshire Hathaway is its reputation. The people that Buffett and Munger have worked with before gang up and implore the SEC to keep off Berkshire Hathaway. Ultimately, charges get dropped. As Charlie has said before, companies built on honesty will always outlast companies built on deceit. After this challenge, and with the full backing of the SEC, Berkshire Hathaway goes on an investing spree, buying insurance companies, culminating with the $22 billion purchase of General Re in 1998. But it's the Salomon Brothers deal that threatens to bring down their empire. The booming economy of the 1980s makes it hard for Warren and Munger to find their next prey. In such an economy, most stocks are overvalued in relation to their book value, and for a giant company like Berkshire Hathaway, finding a company that will cause a real difference to their portfolio is becoming a tall order.
It's nice to add 80 million to 25 billion, but you can't afford to spend lots of time doing that.
However, Salomon Brothers has been doing great. This company holds a special place in Warren's heart, as they were the only company willing to underwrite his loans when he was trying to turn around Geico. While Salomon Brothers is not doing badly per se, Warren still thinks there's more value to be juiced out of the firm. He approaches them and requests for a preferred stock that would yield 15% annually, with the only risk being bankruptcy. Salomon Brothers understand that the news of Warren and Charlie investing in their company will boost investor confidence and drive their stock price up. That's how famous they are on Wall Street already. Salomon Brothers agreed to the deal.
When Warren made his investment in Salomon, I was one of the people, along with many, many others, who were quite amazed, because he had taken a very critical tone in talking about investment bankers and about their greed. And here he was investing in one, Salomon Brothers, that was known to be a member of the club.
And Charlie couldn't stand what was going on there and didn't like the culture at all.
And sure enough, this deal will shake their empire to the core, because the markets are about to crash and the SEC needs a scapegoat to cool the public.
From the Independent News, this is USA Tonight with Brad Holbrook.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points.
Good evening. The stock market today crashed. The Dow Jones Industrials, every other major index, breaking records in its plummet downward.
This is a panic.
People were panicking.
This nosedive was pure investor panic.
Well, panic is the only way to describe what happened on Wall Street today.
On this fateful day, now nicknamed Black Monday, the markets crash. Billions of dollars evaporate into thin air. In the midst of this frenzy, Warren and Munger used the opportunity to invest heavily in companies like Coca-Cola and Gillette in case Salomon Brothers stock tanks. But they don't. In fact, their revenues continue to soar, and the SEC takes notice.
This is NBC Nightly News. Good evening. It is the kind of scandal that rocks Wall Street and raises questions.
Salomon Brothers is under investigation by the Treasury Department, the Federal Reserve, the SEC, and the Justice Department. But more important than the fate of the firm itself is the impact their actions could have on the public trust and on the credibility of the American market worldwide.
The SEC has discovered some covert operations at Salomon Brothers. See, Salomon Brothers is an investment firm. It started out as a trader of government bonds. Now their bond department is huge and accounts for most of their profits. And in finance, when there is profit bags, there's usually also huge risk appetite. One bond trader makes a mistake and manipulates trade options. Unfortunately, the SEC finds out and they launch an all-out war against Salomon Brothers.
Salomon admitted it exceeded the limit of trading in government bonds, once by buying bonds in the name of a customer who didn't even know about the deal.
So to save face, the SEC of Salomon Brothers once again calls on to the two men capable of saving them. If Warren and Charlie say the company is in good standing, maybe, just maybe, other investors will regain their confidence. Warren takes the lead, and he doesn't disappoint. He takes a genius approach. Instead of fighting the SEC, he welcomes them with open hands.
I had to convince the Treasury that what was done in the past was awful and stupid, and they had every right to be furious at us. But this firm employed 8,000 people, and it was going to go out of business unless they let us continue, basically.
He gives them access to every office, every document, and allows them to turn the company upside down. And true to their word, they find the bond trader responsible for the criminal deals. Immediately, he is fired. The company is turned around, and market confidence is widely restored.
Berkshire Hathaway was a large customer of Salomon long before we bought the preferred, and that we've had marvelous service over the years.
While it is not going to be around for a long time, a third crash is already on its way. And this one will be the mother of all crashes.
What we know now is Wall Street can bring down Main Street. And frankly, I'm going to tell you, it's a little scary.
Your company is now bankrupt. Our economy is in a state of crisis.
Did you mislead your investors? And I remind you, sir, you're under oath.
The housing bubble has burst, and with it brought down the financial industry. Two banks, Bear Stearns and Lehman Brothers, have officially declared bankruptcy.
Lehman Brothers is going bankrupt.
It's J.P. Morgan Chase to the rescue, just as investment banker rival Bear Stearns seemed headed for bankruptcy.
The U.S. government said it won't bail out Lehman, which last week announced more than $3.9 billion in losses.
Goldman Sachs would have been the third bank, but 2 years prior, Berkshire Hathaway invested $5 billion in exchange of their preferred stock, pausing their calamity. The largest insurance company, AIG, is also on its deathbed. If there was ever a time the world needed Berkshire Hathaway more than ever, it's now. Treasury Secretary Henry Hank Paulson has done everything in his power to stop the looming crisis. If nothing is done, the USA could slip into a depression greater than the Great Depression. But the morning following the crash, Hank receives an important phone call. After spending the entire night looking for solutions, he finds this call a nuisance. Little does he know that the man on the other end of the phone will literally save the entire US economy. Warren Buffett reveals that rather than the government buying the non-performing liabilities of banks to regain public confidence, they should inject capital into the banks, essentially bailing them out. Of course, this news receives resistance from the public. The public is tired of the government bailing out billionaires for their own mistakes, and while Charlie, Warren and their companies are not being bailed out, they receive the same backlash as other multi-billion-dollar financial institutions, and their unsolicited advice to the Treasury Secretary only makes matters worse. However, the government prevails with its bank bailout plan.
I think those bailouts were absolutely required to save your civilization and to give you the best chances of solving the housing and student loan and other problems. I think that was absolutely required, and we were lucky that both administrations were as wise and bold as they were.
Berkshire Hathaway takes advantage of the crisis and massively invests in failing companies. In 2009, Berkshire Hathaway, for the first time ever, invested all its float money, buying weak companies and bailing some out. Some might argue that Berkshire is the devil in disguise, waiting to pounce on unsuspecting companies that are on the verge of collapse. Others might argue that their business activities have generated hundreds of millions of GDP and lifted people out of poverty. Whatever you think is true, do not envy Charlie.
The other thing you never want to have is envy. That's the only one of the deadly sins you're never going to have any fun at all.
With his ruthless investment strategy, Berkshire Hathaway has become too big to fail, and there's no end in sight to their dominance. If anything, their story is just beginning. If after watching this video you think, wow, this Charlie guy is really a math genius, you haven't heard about this guy, the man that dominates finance, a brilliant math professor turned hedge fund star.